Good to go.
All right. Welcome to the first Cardinal Hill Wealth Management Market Update of 2026. Thanks, everybody, for joining. This is going to be recorded so that folks that can't dial in can watch it later. So we're just going to run through probably, I would say, about a 20-minute update on where we think things are right now with the economy, market in general. We're not market timers, just want to reiterate that point. But it is always important to know where we are overall, and there's a ton of data, so we're going to give kind of a condensed view, and then we'll leave it open for another 20 minutes or so for Q&A. So I think everybody's muted. We'll love to hear questions. Let's just get through the first 20 minutes, and then we'll open it up. But if you could mute yourself for the first section, that would be great. Okay. So our level agenda today is just kind of do a little brief review of the prior year, look ahead for what kind of data do we have at the moment, what are we seeing. And what's funny is, when you submit these slides to our compliance department to get them pre-approved, you kind of have to set the agenda. Well, at the time that we submitted the slides, people were really worried about Venezuela. I don't think that many people are worried about the impact of Venezuela on the market anymore, but we'll still talk about it, just in case you are. Okay, so first off, just to walk this through, I'm actually not going to go into the slides. I'm going to show you, this is our website. This is market news. And this is where I'm going to pull up this weekly market navigator. It's updated as of January 20th. This is really smart dudes in our back office with Commonwealth, some really top economists and investment managers. What I love about Commonwealth is they're not trying to push any product, so they're very agnostic with, what they're seeing. I've found a lot of value in the data that they share over time. Okay, so if you can see this clearly, we're a couple days into this, but at a high level, we're just going to kind of talk through some of the high-level points. In general, positive equity markets so far. Some of the larger cap, so S&P 500 type companies of the world, not quite as strong a growth. I know we've been talking for a long time about small cap companies potentially being poised for growth. We started to see that happen this week, 2%. We'll get to numbers, but year to date so far, closer to 7% or so for the year. So the Russell 2000 is just an index that tracks some of the smallest U.S. publicly traded companies. And large and small companies sometimes behave differently. And so it's interesting to see how different companies are reacting to what's going on. Additionally, there's been some earnings reports that have come out that showed evidence of some potentially higher inflation, not what we're used to seeing during COVID in that era, but it's sticky. It's not really going down lately. And also strong consumer spending, which in general, that's a good news story. We're a consumption-based economy. We're a service-based economy. And so consumer spending is a key part of that equation. So, in general, we want to manage risk in an uncertain world. We already talked through some of those talking points, and then we're looking forward to fourth quarter earnings releases. They don't always release real time. It takes a while for accounting departments to release what happened in Q4 for companies. Okay, there's been a lot of talk lately about geopolitical risks. So as we discussed, there's Venezuela and things like that. But in general, what we think is important is the strength of company earnings. Fundamentals, mainly earnings, drive long-term stock market performance. And so ultimately, while it's good to be informed about geopolitical events, I know there's discussion of the U.S. having an interesting involvement with Greenland. There's lots of policy discussions about Venezuela. Russia's always interesting. China. In general, as an investor, what we're thinking about is under the hood. How does that affect earnings for companies? What kind of policy regime could that play? One of the biggest policy influences is actually from the Federal Reserve. So what is the federal funds rate, as you may hear it referred to? That's kind of the main rate that banks play off of, borrowing plays off of. So far, we've seen some rate drops. Markets are pricing in some additional rate drops in the future. That's a big policy lever that remains to be seen. But in general, we're seeing things play out in this kind of potential for rates to drop, which in a perfect world, that will help small caps a lot. If smaller companies have cheaper borrowing, that can influence their earnings potentially in a disproportionately positive manner, because the big guys in the world, they can get whatever financing they want. That's kind of the theory. So what's next? Well, there's a lot of inflation data that's already come out. There's retail sales data. The high-level talking point, CPI, the Consumer Price Index, is above what the Federal Reserve wants. And so the Federal Reserve has kind of two main goals. They have a dual mandate. They want to keep inflation in line and the economy in line, mainly in terms of labor. And so they try to pull levers with the interest rate to control that and everything. And so the Fed's not super happy right now that inflation is above their long-term goal of 2%, but it's a little bit difficult to manually manipulate that. Here's some of the return numbers that we're seeing. These are a little bit different today, but as you can see, year-to-date so far, large cap companies, they're seeing a fairly stable environment, good earnings. Tech is still positive. But you're seeing some of the things that we've talked about in prior, market updates pan out. You're seeing international had a great year last year. Europe, developed markets up 34%, emerging markets up 42%. Year to date, they're still up about 6%. And then while small caps last year had not the same rally as international, year to date so far, we're starting to see some of that pan out. So it's things like this that is why we believe so strongly in diversification. We really don't know which part of the market is going to respond well in the short term, but when you theoretically buy the entire basket, as long as it's healthy, profitable companies, hopefully that evens out in the portfolio as a more sustainable growth rate. So yeah, in general, we're seeing some evening out of the market in terms of which parts are priced more appropriately. We'll talk about that in a minute. And so, yeah, looking ahead, we'll have different government data releases with inflation and spending. There's definitely some big earnings reports coming out, everything from technology to oil and gas and healthcare, industrials. So far, since this came out on the 20th, now to the 3rd, there haven't been the overall sentiment is still things kind of playing out in a positive direction. So I would say the take-home message from this data source is cautiously optimistic. There's a lot of good signs in the market. There's definitely causes for concern, but I think we've been saying that for the last couple of years, cautiously optimistic, and that seems to be what's panned out. So I'll pause there. Jesse, any comments on that before I pivot to the PowerPoint?
Not yet.
All right. Okay, so now I'm going to pull in some other data just to talk on some of the major points that I think are interesting in greater detail. The first couple is from the JP Morgan Guide to the Market. There's a lot of different theories on what's the biggest predictor of the health of an economy. In general, I think labor is really important. And that really just comes down to jobs and unemployment rate. And so we're going to talk through these graphs. In general, we look at non-farm payroll gains, so change in the number of jobs that don't have to do with farming. That's kind of the generally agreed metric to look at. We're still seeing some positive gains. The rate of those gains is going down. You may say, why? There's been some pretty significant shifts to the labor market. One of those major shifts is immigration. So as that's getting tightened, some of the trade jobs, blue collar jobs, as many people call them, the supply of that labor is potentially shrinking, there's still some demand for that, and so that can lead to changes in the unemployment rate. We still see over here on this side, unemployment rate is still in a fairly healthy place. It's rising a little bit, but below kind of a long-term historical average. So right now, in November, the data we had was 4.6. There's a little bit of delays because of the government shutdown, but we're still below kind of that 30-year average of 5.5. And while the wage growth rate is dropping, it's still positive. So people are making more money. Unemployment, big picture, is still in a healthy spot. And so even though some of these shifts are happening with immigration, and so you may go, well, what's the future going to pan out to be like? We don't know, but in one theory, there's job shifting. So there may be more U.S. citizens that say, hey, you know what? It's not so bad to be a roofer. It's not so bad to be a plumber or an electrician. You may see some shifting in the economy with people's preferences and desires. But right now, this is kind of where we are. What's another metric to see how are we doing as an economy? GDP growth is a big part of that. It's for gross domestic product. Overall, how much money is being made in the U.S. So there's a lot of noise in this graph, but I want you to focus on this light blue bar over time. That's consumption. Do you remember we talked about consumer spending is a big piece? Well, this blue bar is that consumer spending piece. Between last 25 years, that's 68% of GDP. And so right now we're looking at fairly healthy consumer spending. So what's the biggest changes? We can kind of see these purple bars. That's net exports. And so as you can remember, there's been a lot of changes to tariff policy and things like that over time. So you saw a big negative and then a kind of a rebound effect, starting to see the data normalize a little bit more. There's a lot of changes and a lot of influx, but markets are fairly adaptive. In general, this gray bar here, you can kind of see some thicker components to that bar. In a big picture, what I feel like that is mostly is a lot of this AI investment that businesses are making, the capital expenditures. So they're deploying a lot of money, which is spending, which kind of, in my theory, is propping up the S&P 500 for a while. And that's been real. You can see that this bar is getting thinner over time. So companies may not deploy the same level of AI investment in the long term as they have over the previous 2 to 3 quarters. But overall, in general, we're seeing a positive real GDP growth. And so that's another cautiously optimistic sign. In terms of zoom out over the whole world, what are we looking at in terms of health of different parts of the world? This chart is a little messy, but in general, it's trying to show the components of like the market going up and the stock price improving. You can kind of decompose that into a couple big factors. So first off, the blue part, these little blue bars here, that's the earnings of a company. So you can kind of see in 2024, U.S. market returns, a healthy part of that was because U.S. companies made money. Well, in China, they did as well, not as much earnings. Japan, we increased our position in Japan last year. We saw some active managers had not in nearly enough Japan exposure just to hold the line. And that was a good thing. Healthy earnings in Japan. And then this is what happened in 2025. So still positive earnings in most parts of the global economy. So that's a good thing. The purple is currency changes. So you may have heard of like a weakening dollar. So in 2024, for example, negative aspects of currency shift hurt their return. So that Japan was still positive in 2024, but 2025, there wasn't nearly as much currency exchange that helped Japan. It did a little bit. Whereas, if you remember those positive returns that we saw in Europe last year, a big component of that was currency appreciation. In the long term, the currency stuff just kind of is a lot of noise. It's up and then down, up and then down. So we want to focus more on earnings. That's a big component. But then lastly, when people say, oh, is the market overpriced right now? That's this dark gray bar, the multiples. So the multiples is basically how many times current earnings are investors willing to pay. And the bigger those gray bars over time, they're saying people are willing to pay more and more, 20 times earnings, 25, 30 times earnings. And that can, in the short term, reverse. So you can have a 2026 scenario where the blue bars are still healthy. Let's say in the US, people are still making money, but investors change their opinion and they say, I just don't think I would want to pay the same amount for those earnings as I did before. And so that can hurt stock prices in the short term. So again, zooming out big picture, we're seeing healthy earnings across the board, cautiously optimistic. But in the short term, how could 2026 play out? A lot of that has to do with investor sentiment, and that comes down to the multiples. But in general, cautiously optimistic, and we do see some real opportunities outside of the U.S. as well. So we want to maintain our exposure there. Okay, lastly, I thought this was interesting. BlackRock kind of has an attempt to decompose geopolitical risk of various types into a single metric. It's a guess. And so at a global level, you can kind of see, according to their dashboard, how did they feel the risk was in different points in time, and was that fairly accurate? So you can see their little model was saying, hey, 2020, pretty high risk time. That was during COVID, and you can kind of see things were good, and then Russia invades Ukraine. This little line right here is when Cardinal Hill Wealth Management was launched. That was a fun day. And then you can kind of see some of these other geopolitical events play out, and rising overall investor sentiment saying, hey, we're not sure about the environment. The more uncertainty, the more that can put a damper on stock prices. It can. And as you can see right now, we're in a fairly neutral environment. So while things like Venezuela and other geopolitical events can be really big news stories, an investor, thus the market, is really trying to break that down in terms of what does that do for the health of businesses. And so far, the market seems to be pricing Venezuela and a couple other things as basically a blip on the radar. Relatively immaterial, although if you're in the oil and gas industry, it could be a significant opportunity. And I am not trying to make a political statement, positive or negative. That's just the way the market's pricing it.
Robert will do that after hours over a beer.
There you go. So I think that's the end of the Dog and Pony Show in terms of...
I've got a couple of slides I'd like to hit real quick before we go to Q&A, and then we can go from there. So let me share my screen. There we go. Okay, so a couple of things. Robert already hit this, but a little bit before y'all have a second to take that in. I'll switch. What do y'all think? Just take a quick guess. What was the highest performing asset class last year? Amber, you can guess since no one else is going to guess. I'm putting you on the spot. All right, I'll give it to you so that no one has to feel like they're going to get it wrong. So it was emerging market, right? So emerging market equities, and they are not always the best performer. This is like, I call it the jelly bean chart because it's a bunch of different colors slapped on there. And what I like about this chart is it really does show that no matter what any of the chief economists say, they're all guessing, right? It's kind of like the weatherman. I think that they do their best to put an educated guess together, but they just don't know what's going to return well. So just breaking down this chart, this is the different broad asset classes as far as predominant, a lot of equity on here. There's a couple bonds and cash on here, but a lot of equity. Well, emerging markets and then developing world is, Europe, Asia, and some of Asia. They crushed everything last year as far as performance is concerned. And we have a lot of people that don't work with us that were like, there's no way I'm investing in international. It's just not going to outperform the U.S. And we just don't know what's going to happen. And so that's why we're just broadly diversified as a philosophy. And then with that, we didn't go into this at all, but really quickly, who you pick to manage your assets is really important, not just as Cardinal Hill Wealth Management is concerned, but as far as who is your portfolios or who is the fund managers that you're picking, right? And so I love this chart because there really is a difference between the best managers and the worst managers. And so this is highlighting the differences between the best and the worst. But just to kind of break down this chart really quickly, I'll pick on foreign large blend. So this is just overseas core holdings, and you see a difference of 145% returns over a 20-year time frame. So the difference is not great when you're just talking in regards to $1,000, right? You look at it and you go, well, it's $1,400. Well, if we're talking a lot bigger dollars, I would much rather 145% upside. So why am I talking about this? I just want to highlight when we go and build portfolios, we are taking a lot of time to make sure that we're selecting who we believe to be some of the best managers out there in the industry regarding your investments. So I think it's just really important. Last one, too, that I'll talk about. This is just a lot more on the behavioral finance side of things. This is just showing what a 100% stock, 100% bonds, and then what a 60-40 portfolio does over a 1, 5, 10, and 20-year rolling time frame. So, and this is dating back all the way to 1950. So again, just to put this in perspective, what is it? A 1-year rolling time frame is, it would say we're going back, if today is January 23rd of 2026, what if you invested January 23rd, 2025? And it does that for every single day going back for the last 50 years on a 1, 5, 10, and 20-year rolling average. So I think just what's important to see on this is on a 1 year, this is the worst possible returns that we've seen over a 1 year since 1950, right? 37% down. We all know what year that was, 2008. It was brutal, right? And that was all of these worst numbers was 2008. And so if you were in all bonds, you would have done a lot better than this. We think that a 60-40 for most retirees gets you a good blend, right? Of we're not too terribly down. We don't get crushed as bad as this, but we aren't quite that good because we want some long-term trade-off for the upside. So this is the best 1 year, right? If you're 100% stocks, my guess is this is 2009 when this happened, but you were up 52%, maybe 2010. But as time goes on, your chances of negative returns diminish immensely. And to the point where you get to a 20-year rolling average, man, that looks really good. Worst case over a 20-year average, you're getting 18%, or that's best case, worst case is 6%. So I just like to show this chart every time because diversification matters, a good stock to bond ratio matters, and staying invested really matters. And so I like to hit those just so everybody's on the same page of how we think. And we really love investing for the long haul. That's why we're investors, not traders. And so now I'm done. Now we can open it up for questions.
All right, so we can sit here and awkwardly stare at the screen for 20 minutes, or somebody can be brave and ask a question.
Well, you just showed that great graph where you said for the long haul, the 6% up to 18, I think it was.
That's right.
So here we are today in the 23rd, and I'd say this couple weeks has been somewhat volatile. You know, what kind of things worry you to get to those kind of returns? I mean, is there anything we can be doing as investors right now?
Yeah, so great question. I'll go first, and Robert, if you want to add on, you can. But I think that the point here is we are going to actively be managing y'all's portfolios if they're with us. So what does that mean? Number one, we are always reviewing what we are holding within those portfolios, right? So we are going to be making sure that every fund or ETF that we own is doing what they said it was going to do. So that's number one. Number two, we are actively rebalancing your portfolio to make sure that we are selling high and buying low. That's all a rebalance means, right? So we're going to be taking from the stuff that has done really well, and we're going to go buy the stuff that hasn't done as well or has maybe actually done poorly. But that is the discipline of rebalancing. We, a lot of times psychologically, if we have something in our portfolio that's doing really well, there's a temptation to not sell high, right? And so we just have a very strict discipline to take care of that on your behalf. But those are the two items that come to mind that we know that we're doing for you on a regular basis, is reviewing your holdings and actively rebalancing.
Okay.
Yeah, I would agree, Jamie. I think the thing I would add is to stay abreast of some of the stuff that's happening in the market that may be different than before. So I'll give you an example with the bond market, which is really a pretty big deal for our retiree clients that are living on their money, because it's a higher percentage of their portfolio. So y'all are probably familiar with like indexes like the S&P 500 or whatever, and that's a basket of the 500 largest stocks. Well, the Barclays Aggregate Bond Index is probably the most popular, most widely used index people use to talk about bonds. So that fancy chart Jesse just showed, the 40% is coming from the ag, as it's colloquially referred to. Well, the ag is changing in a way that I personally don't love. Jesse doesn't love either. We don't love it. And why is that? Well, as the government continues to print a ton of debt in the form of treasuries, the percentage of the ag that is the treasury component is rising. Just as they continue to print debt, the ag becomes disproportionately a barometer of government indebtedness. And you as an investor theoretically aren't getting paid for 2 out of the 3 levers that you should get paid for bonds. And that's credit risk, because the government theoretically should never default. Liquidity risk, because I can buy and sell treasuries immediately, and interest rate risk. Well, that's where you get paid, the 4.2 whatever percent you get for treasuries. We don't think that that's a very diversified approach for bonds, but a lot of advisors and investors are just owning the ag. And that's just kind of an inefficient approach. So what we're doing is a ton of research right now with, as the ag, and this is true with equities as well, it's just an illustrative example. As the ag continues to move, we're looking for opportunities to get diversification, so bonds that move differently, and an opportunity to have higher yield so that you as an investor are getting paid. Some of these discussions are new-ish to the industry. So another thing that's happening with bonds is more and more companies are going to private markets. So the term private credit is something you may have heard. That's technically an alternative asset class. So a lot of businesses are just going straight to a lender and saying, hey, can we do a deal? Well, some of these private credit funds are paying a very attractive 10% yield. Well, they're not necessarily as transparent. They may not have the same bond covenants. They may have liquidity problems. You want all your money, you can't get it. You can get gated, and then you get 10%, and you got to wait for the next quarter. So there's a ton of risks. So I just think a lot of it just comes down to staying abreast of what's happening in the market as things change, and that is not to try to market time. The goal there is actually to maintain a long-term investment plan, but you actually have to do a lot of rebalancing, as Jesse was discussing, and research in order just to hold the line. And that's something that, you know, we try to do for y'all every day. And I just think a lot of it just comes down to education and just staying aware of what's happening.
Well, keep exercising, Jesse. I hope you guys keep exercising and using that espresso machine.
Hey, come by. You can get a Cardinal Hill branded cup, Jamie. If you don't have it already.
There you go. Thank you.
Yes, sir. Who else? Quiet crowd today.
I didn't know it was going to be a test today, so.
Hey, well, you get extra credit because you spoke up.
All right.
Jesse, you're
When
muted. There you go.
yeah, I got it. Yeah, when we don't get any questions, I just always think that means we just did a really good job and people trust us. So, yeah, if that's not your sentiment, this is your perfect time to speak up. But, well, we are here for phone calls if you need us, and we really appreciate you guys jumping on.
Thank you, guys.
So,
Thank you.
All
is
right.
good.
Y'all take care.
I like
Stay
it.
safe with the crazy weather.
cool. Bye, y'all.
Bye.
Thank you, guys.
Bye.
Be safe.